Imagine this. Your portfolio pays you like a salary month after month without fail. No boss, no alarm clock, just cold, hard cash flowing in from Dividend Aristocrats. But here's what most people miss. There's a way to keep that income and unlock a bonus payday without touching a single dollar of your principal. We're talking 4.9% dividend yield and the shot at 30% plus gains on top. Sound impossible? It's not. And I'm going to show you exactly how. In this video, I'm revealing 3 Dividend Aristocrats that aren't just paying steady income, they're trading at rare deep discounts most investors are ignoring. You'll see how each company makes money, the risks you need to watch out for, and why we believe their stock prices are seriously undervalued. This is your blueprint to build passive income while unlocking long-term upside like the pros. Let's break it down. Dividend Aristocrats are the royalty of the stock market. To earn the crown, a company must raise its dividend every single year for 25 straight years. That's not just consistency, that's surviving recessions, crashes, inflation, and still paying you more every year. These companies don't just weather the storm, they reward you through it. Why does that matter? Because dividends are the lifeblood of passive income. If you're retired, a dividend cut isn't just a number. It could mean skipping dinners out or canceling that dream vacation. That's why rock-solid dividend payers matter more than ever. So now you've got a key piece of the puzzle. Let's move into the strategy that can build massive long-term wealth. So here's the strategy. We're blending 2 of the most powerful investing styles, dividend investing and value investing, into one wealth-building machine. Dividend investing gives you steady, predictable income like clockwork. It keeps the cash flowing even when markets get rough. But let's be real, the returns are usually modest, maybe 3% to 5% at best. Now, enter value investing, the art of buying a $100 bill for just $70. The upside? Massive. But the catch? You don't know when that $70 turns back into $100. It could take a year or 10. Timing is the unknown. Here's where the magic happens. Combine both styles, and it's like owning a money machine that prints cash reliably every month. Even better, it comes with a mysterious bonus, a payout that shows up later without warning. But you're never stressed, because you're still getting paid every step of the way. Then one day, boom, the bonus lands. And maybe that bonus is the vacation of your dreams, or the freedom to retire early. And if you're thinking, sounds amazing, but where do I start? We've got you covered. Up next, 3 Dividend Aristocrats paying reliable income today and trading at bargain prices most investors are missing. These aren't hype stocks, they're boring, beautiful, and quietly powerful. Let's start with the first one, MDT. MDT, Medtronic, is one of the largest medical device companies on the planet. From pacemakers to insulin pumps to robotic surgical tools, they're not some niche biotech gamble. They're the backbone of global healthcare, pulling in nearly $8 billion in revenue just last quarter. And while the world's still wobbling from economic uncertainty, Medtronic is gaining momentum. Cardiovascular segment? Up. Diabetes tech? Up. Surgical innovations? Making a comeback. So why is it on our radar now? Medtronic pays a 3.3% dividend, already above its 5-year average. For income investors, that's solid. But here's the real kicker. It's trading at a forward PE of just 15.7 times, compared to its historical 17.5 times. That's a 10% discount on a blue-chip dividend payer. It's like buying a luxury car you know will hold its value, only it's got a markdown sticker thanks to short-term market noise. Of course, a discount like this doesn't come out of nowhere. Medtronic does face some headwinds. MedTech is a competitive field, and MDT's facing challengers. And macro headwinds, like tariffs and hospital budget cuts, can squeeze margins. But here's the key. None of it is structural. The core business is strong. Wall Street's projecting 4.5 to 5% organic revenue growth, improving earnings and tighter margins. Plus, the payout ratio is under 50%. So that dividend? Plenty of breathing room. Bottom line, this is a cash flow powerhouse, temporarily mispriced. And for long-term investors, that's your window. You're getting paid now and positioned for a bounce back later. In a noisy world, MDT is a calm, confident hold that lets you sleep easy and still win. We've covered healthcare. Now let's shift to something you probably have in your fridge. This next Dividend Aristocrat dominates shelves, pays strong dividends, and grows in any economy. Pep. This one might surprise you. Pep isn't just Pepsi. It's a global powerhouse that rakes in over $90 billion a year across snacks, drinks, and packaged foods. Gatorade, Quaker, Cheetos, Lay's, 7-Up, if it's in your fridge or vending machine, chances are PepsiCo owns it. Right now, it's trading at a discount that almost never happens. The forward PE is just 16.6 times, compared to a long-term average of 20.9 times. That's a 20% markdown on a Dividend Aristocrat that practically owns the snack aisle. And the dividend? A rock-solid 4.4% yield, above average, backed by 50-plus years of consecutive increases. That's not just stability, that's legacy. Now, there are headwinds. Commodity prices, sugar, corn, palm oil, are volatile. Global logistics are messy. Currency risks and competition from Coca-Cola and Nestle add more pressure. But here's the kicker. PepsiCo isn't standing still. They're investing in automation, optimizing supply chains with AI, and expanding into international growth markets. They're also adapting to changing consumer habits, from low-sugar drinks to healthier snack options. These aren't buzzwords. They're real moves that are already boosting margins and long-term resilience. This is the kind of stock people overlook until it quietly builds serious wealth. While others chase hype stocks with no profits, Pep pays you 4.4% to hold one of the most durable businesses on the planet at a rare discount. As input costs normalize and supply chains improve, there's every reason for PepsiCo to bounce back to its historical valuation. And when it does, investors who buy at today's price will be sitting on steady income and capital gains. We didn't expect to find deep value in a soda and snacks company. But the numbers don't lie. Pep is a defensive juggernaut, temporarily mispriced and seriously underappreciated. And if that sounds good, wait until you see the final pick. It's been hammered lately, but under the surface, it might be the most undervalued Dividend Aristocrat on the list. SWK. SWK, Stanley Black & Decker, isn't just power tools. It's one of the most iconic industrial brands in the world, serving both everyday consumers and heavy-duty pros. Yes, they make DeWalt drills and Craftsman lawnmowers, but they also build industrial fastening systems, security tech, and engineered components used in global infrastructure. This is a diversified manufacturing giant with deep roots in both homes and highways. But here's the wild part. It's trading like it's broken. Right now, SWK has a forward PE of just 18.8 times, compared to a historical average of 27.2 times. That's a massive 30% discount. Stack on a 4.9% dividend yield, and this becomes the most undervalued stock on our list. So what's the catch? Let's be real. This stock has baggage. Consumer sentiment is weak. Manufacturing's been in a slump for months, and geopolitical instability from Eastern Europe to the Middle East threatens oil prices, shipping costs, and global supply chains. Add in the threat of tariffs, and margins take another hit. But here's the flip side, and it's a big one. Stanley Black & Decker is fighting back. They're cutting costs, streamlining operations, and tightening inventory. A $500 million cost-saving plan is already driving margin expansion and free cash flow recovery. Management is focused on strengthening the balance sheet and cutting debt, all without touching that juicy 4.9% dividend. And here's what really sets it apart. 56 consecutive years of dividend hikes. Not just payments, increases. Through wars, recessions, inflation, they've kept delivering. The market is punishing SWK for short-term noise, but long-term, this is a company with global scale, battle-tested leadership, and a proven history of turning adversity into opportunity. No surprise, analysts expect earnings to rebound within the next 1 to 2 years. This is where value meets patience. It's riskier than PEP or MDT, no question. But if you're comfortable with a little volatility, SWK offers serious income and big rebound potential in one tight package. That's it. 3 Dividend Aristocrats, 3 deep discounts, and 3 powerful ways to build income and long-term upside in one shot. The market may be uncertain, but these businesses aren't guessing. They're paying you to wait. And sometimes, patience pays off with a big prize. Ready to level up your income portfolio? Tap the video on your screen and let's keep stacking smart, sustainable returns.